You're about to make your first investment. You've chosen your platform, you've picked your first ETF, and you're ready to start building wealth. But what if I told you that there's one single mistake that derails over 90% of new investors? It's not about picking the wrong stock or ETF. It's a psychological trap that can cost you thousands, even tens of thousands of dollars over your lifetime. Today, we're going to identify that number one mistake, and I'll give you a simple three-step framework to ensure you never fall for it. Let's begin. The single biggest mistake a new investor can make is emotional investing. This is when you let fear and greed dictate your decisions instead of logic and your long-term plan. It happens in two ways. The first is panic selling. The market has a bad day or a bad week. You see your account value drop, and your brain's ancient survival instincts kick in. That fear is real. You think, I have to get out before I lose everything. So you sell your investments at a loss. The second is FOMO, or the fear of missing out. A meme stock is soaring. A new cryptocurrency is all over the news. Your friends are talking about their gains. Greed kicks in. You think, I have to get in on this. So you pile your money into a speculative asset at its peak without any research, hoping for a quick win. In both cases, you are buying high and selling low, the exact opposite of what you're supposed to do. To really understand the damage this can do, let's look at the tale of two investors. The tale of two investors. Meet disciplined Diana and emotional Eric. Both start investing at the same time with $10,000 in a simple S&P 500 ETF. For the first year, the market does well. Both Diana and Eric are happy. Their accounts grow to $11,000. They feel like geniuses. Then, a recession hits. The market drops 30% over the next few months. News headlines are filled with words like crash, crisis, and collapse. Eric panics. He checks his phone every 5 minutes, watching his account fall from $11,000 down to $7,700. He can't stand the fear of losing more. He sells everything, locking in his $2,300 loss. He tells himself he'll get back in when things look safer. What does Diana do? She feels the same fear, but she remembers her plan. Her plan was always to invest for 30 years. She knows crashes are a normal part of investing. So she does nothing. She might even stop looking at her account. Her account is also worth $7,700, but she hasn't sold. Now the market always recovers. Over the next year, it rebounds 40% from its low point. Eric, who is still waiting on the sidelines for a safe signal, misses the entire recovery. He's waiting for good news, but the biggest gains happen when the news is still uncertain. His $7,700 is still sitting in cash. Diana's account, however, experiences the full 40% rebound. Her $7,700 grows to $10,780. She is now back in profit, while Eric is still down over $2,000 and has missed a massive opportunity. Eric made the classic emotional mistake. He sold at the point of maximum pessimism and missed the point of maximum opportunity. Diana simply stayed in her seat. That one decision, repeated over a lifetime, is the difference between building wealth and destroying it. So how do you make sure you're a Diana, not an Eric? Here are the 3 simple rules. Solution number 1, have a plan. Before you start, never invest $1 without knowing why you're investing it. Professionals call this an investment policy statement. It doesn't have to be complicated. Before you buy anything, get a piece of paper and write down your goals. Is this money for retirement in 30 years? A down payment on a house in 5 years? Your timeline dictates your strategy. This isn't just about goals, it's about setting rules for yourself when you're calm, so you're not forced to make decisions when you're panicked. Your investment policy statement should be a single page. On it, define your risk tolerance. Are you aggressive, moderate, or conservative? This will determine your mix of stocks and bonds. Also, write down what you will do in a market crash. This is the most important part. For example, if the market drops 20%, I will not sell. I will check that my portfolio is still aligned with my goals, and I will continue my automatic investments. Reading this statement during a panic is like having a map in a storm. Knowing your timeline helps you ignore the short-term noise. A bad day in the market doesn't matter if your goal is 30 years away. Your written plan is your anchor. Solution number 2. Automate everything. The best way to remove emotion from investing is to remove the investor from the day-to-day decisions. Your own worst enemy is often yourself. Use the automatic investment feature in your brokerage account. Set it up to automatically invest a certain amount of money, like $100, every single month on the same day. This is called dollar cost averaging. It forces you to buy consistently, whether the market is up or down. It acts as a behavioral guardrail, preventing you from making impulsive trades based on the news. This also combats something called decision fatigue. The world requires us to make hundreds of small decisions every day. By automating your most important financial decision, your regular investment, you free up mental energy. You're no longer asking yourself, is now a good time to buy? The system decides for you based on the calendar, not the headlines. It is the most powerful tool for enforcing discipline. Set it and forget it. Solution number 3, zoom out. When you feel the panic of a market drop, your instinct is to look at the 1-day or 1-week chart, which will be a scary sea of red. You need to fight that instinct. Force yourself to look at the 5-year, 10-year, or even 50-year chart of the S&P 500. You will see a clear, undeniable trend. Despite all the crashes, wars, and recessions, the market has consistently gone up and to the right over the long run. Historically, the S&P 500 has delivered an average annual return of around 10%. Legendary investor Peter Lynch once said, "Far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in corrections themselves." This is the essence of zooming out. The real danger isn't the temporary drop, it's the panicked reaction to that drop. That's not a guarantee for the future, but it's powerful historical context. Short-term volatility is the price of admission you pay for those long-term returns. Zooming out is a powerful mental trick that reminds you that you are playing a long game. So, to recap, have a written plan, automate your investments, and when in doubt, zoom out. Investing success has very little to do with being a genius stock picker or a market timing wizard. It has everything to do with controlling your own emotions and staying disciplined for the long haul. By avoiding the single destructive trap of emotional investing, you are already putting yourself ahead of 90% of the market. If you found this video valuable, do me a huge favor and hit that like button. It really helps the channel grow. And make sure you subscribe and turn on notifications so you don't miss future videos where we'll dive deeper into building wealth and mastering your money. Now I have a question for you. What's the biggest investing mistake you've ever made or are worried about making? Drop a comment below and let me know. Thanks for watching, and I'll see you in the next one.